Well, Justin, it's an honor as well as a pleasure for you to join us this evening. And really excited to do this interview. And let's get right to it. I mean, you're the owner of Bright Path Notes, is that correct?
Yes.
Yeah. So let's talk a little bit, I guess, about how you got started in this business. I mean, I was reading your through your bio, and I saw you got started in early 2000s, kind of doing like the fix and flips, and got started with that, and then kind of how did you transfer into the note investing business?
Yeah. So like you mentioned in my bio, I had always had an affinity for real estate ever since I was watching HGTV and thought I could flip houses and make $40,000 just like that, magic out of thin air, not realizing how much work is involved with it. So after many trials and tribulation and a couple of failures and a couple of bombs, with fix and flips and rentals and stuff like that, I fell into mortgage note investing because my future mentor then was coming to town and educating about it. And so I just was kind of intrigued by real estate note investing. And I said, this is way better for me. I want to use a calculator. I want to use a spreadsheet. I don't want to deal with tenants, toilets, and trash or contractors per se. And I just didn't have a system built for it. So that's kind of how I steered into the note business.
Sure, sure. So who was your mentor? You said your would be then mentor came to town, I guess started teaching you. Who's your mentor?
Yeah, so the guy that came to town was Joe Barnador, and he is with Note School, Eddie Speed's Note
Okay.
School. And so
Yeah,
he
for
kind of
sure.
started me down this journey. And then Eddie is also a mentor of mine, as well as a couple of other educators in their program as well. So I've definitely gotten all my training from them. So I feel like I'm pretty well versed in the note space, and I kind of specialize in seller financing performing loans is where I kind of landed at, where I spend most of my time.
I got you. So yeah, let's talk about your Bright Path notes. I see you got some notes listed for sale, things like that. Let's if you could just give like a overview of like your business. I mean, what are you guys doing? Are you guys holding the notes, some of them, or are you guys like buying reels and then reselling the majority of those, or what are you guys working on?
The answer is kind of all the above.
Right.
So I tell
I
people we got
figured.
three pillars of our business. We buy loans, we sell loans, and we help people create loans as well, as far as originating seller financing. And so we mainly end up educating first time investors or lightly seasoned investors in the note space, and kind of hold their hand and help them along maybe one of the first two, three, four, five, six deals, and just kind of coach them through the process of how it works, help kind of manage their portfolio as well. And they kind of like that. And so that's kind of what we do mainly in for our business, is find deals for people and kind of walk them through why it's a good deal or why we see things that could be a problem.
I got you. So you guys are holding those deals, I guess, until you can resell them to an investor, or you're just keeping them pretty much for the most part then.
Yeah, when we first started, we were kind of had to be picky, and we couldn't be as picky and choosy when we first started, because we were new to the business and we are just trying to buy things, to get things going. And now we've established ourselves. We're pretty seasoned. We've we've taken down a lot of loans, and we've helped people take down a lot of loans as well. So we can be a little more picky and choosy. So we'll have loans for our inventory. We'll kind of pick those, and we may sell them or we may hold them depending on what account it's in. We have it
Sure.
in a retirement account, or if it's like an LLC type of cash account, we may end up selling those. We do a lot of partials for people. We buy partials from people as well. So kind
I
of a
got
mixed
you.
bag.
Right, right. Well, that's pretty much how the note investing industry is, right? You always got to be flexible, right?
Yes.
But I mean, what type of areas do you have like a certain market you invest in? Or are you doing all 50 states? I noticed a lot of your just briefly looking at your site, what you had listed was kind of in the Midwest, kind of where I'm at. I
Mhm.
saw a few in Gary, Indiana. I know Gary, Indiana quite well. So,
Okay.
but yeah, yeah. So, are you just in the Midwest, or are you in all 50 states?
We typically end up in the Midwest. We do not go to all 50 states. We
Okay,
are able to go to all 50 states if we want to.
sure.
Just certain states we don't want to get into. We
Right.
look at what's worst case scenario, and going through a foreclosure is worst case scenario, time and money. And some states will cost you more time and money than others. So we stay away from the East Coast. We stay away from the far West Coast. We like the Southern states, and we like the Midwest definitely. So that's where we just
Sure.
end up right there.
I gotcha. So when you're looking to buy notes, I mean, there's, note investing is a very fragmented place, right? I mean, do you have like a specific place you're looking at more than others? I mean, are you buying them in bulk, or you kind of just seeing what comes your way and kind of picking and choosing, kind of like you said, like, they got note investing groups on Facebook, you got Paper
Yeah.
Stack, you have all these different places, such a fragmented market. Um, where are you kind of sourcing these notes at, or is it all over?
It is kind of all over the place, and we do get deals that come to us. We've done a good job of spreading the word that we invest in these loans, we educate about them, and so people actually bring us deals as well as whether we're going to buy them or we're going to broker them or sell them to one of our investors. We do look at a couple of hedge funds pretty regularly to see what they have. A lot of that inventory, they don't have as much of it as they used to 2, 3, 4 years ago. So that inventory is a little more challenging to find, but we've also found that we are marketing to seller financiers. So people that are like what we call the mom and pop of real estate, to where they have this property, they couldn't sell it, they sold it on land contract or a note and mortgage or deed of trust, and they
Mhm.
record that document at the county. And so we do county research and we figure out who they are and we market to them, whether it's SEO or mail or just cold call, phone calls.
I got you. I got you. Yeah. So, what I do personally is I originate the notes. I'll buy the property and then sell it. Kind of, that's my business in the note space. But yeah, I always get the direct mail piece from some bank who's,
Yeah.
hey, come sell, come buy your notes. So that's interesting.
Yeah.
I know who sends me that mail now. I can blame you for that now, right?
You can. Yeah. You need to
Yeah.
respond to me so I can buy some
I
of your
know,
deals.
right? Yeah. Well, yeah, let's talk a little bit, I guess, about that, like the current market. I've had a couple of people on. Last week we were talking about, for me, I don't buy notes unless I create them, or I don't own a note unless I create it. So, but just seeing the crazy offers that I've been receiving in the past year for buying the notes that I'm originating, notes that aren't seasoned, people are just like, I'll buy it, and they're buying it at a much higher price. I mean, is it the market really that hot right now, or kind of what are you seeing in the market?
I wouldn't define it as being hot or cold. I would define it as being not a lot of people that are either first time in the business or kind of lightly seasoned or had some proper training really know how to source deals, or like yourself, how to create or harvest your own loans. So
Right.
that's a bonus for you. So you don't have to go look for inventory. You're creating the inventory. I know a lot of different avenues and different ways to acquire notes. It isn't just looking at you mentioned PaperStack. It isn't just looking at that website. It's a lot of different ways, and it's a lot of marketing and branding that I've done for our company that's allowed people to come and say, "Oh, hey, Justin buys loans, or let's try him. I know he buys them. Let's see if he buys this type of loan." And so we get those opportunities pretty regularly on a weekly basis.
Okay, I got you.
Mhm.
Yeah, just looking at from my side, a couple people, smaller investors that I'm talking to who are normally buying a few notes, they're just saying like the note sources are kind of drying up. Maybe if you're not as a big time investor like you, it's you don't have as many avenues. But same thing for me. I just seeing people, offering a lot more for unseasoned notes, that type of thing. Just seems like the market is kind of shoring up a little bit. But the prices, properties are going up too. Obviously the real estate market's
Yeah,
booming right now, so that's another element. My buy side's a little bit higher too. So
yeah. So the real estate traditional market is definitely on fire, and properties are appreciating. The worst city out of the top 50 cities is Pittsburgh, Pennsylvania, and it's still appreciated at 10.8% annually.
is that really?
Yeah.
I would have never
So
guessed. I would have never
yeah.
guessed Pittsburgh.
So we had done our live monthly broadcast earlier this week, actually yesterday evening, and so we talked about what's going on and stuff like that. So those are the types of things that we bring up on our little broadcast that we do, our live little YouTube stream. And so it was interesting that we saw that data too. So we had to put it out there to say, hey, look, you can look at this a couple different ways, but here's the fact. Pittsburgh, Pennsylvania was 10% annual appreciation. Austin, Texas was 45.6% annual appreciation. So we saw all this appreciation in these houses, mainly kind of in the deep southern, like Florida, the far west coast, in California, the more affluent areas there, and then kind
Right.
of spots here and there in Texas and a couple other places. So it's just really interesting to see that data where
Sure.
property values were raising.
So I know Texas is, pretty hot market for notes. They're pretty note friendly. What about Pennsylvania? I have looked at a few deals in Pennsylvania, but I've never done a deal in Pennsylvania. Is Pennsylvania a pretty friendly state for notes?
I would say yes and no. I don't have a lot of loans or have had a lot of loans in Pennsylvania. Some states require some sort of debt licensing, and there are ways that you can get around that to, adhere to those rules and regulations. So Pennsylvania, I've heard is possibly one of those states. So if those
Sure.
states are a little bit of a challenge to get into, then I typically do some more research if I want to invest in it, or I typically find a deal somewhere else. But you mentioned Texas. Texas is the largest state as far as creating seller finance notes because they have a lot of dirt that they create paper on. And
Right.
so then, Florida is a big one. North Carolina is a big seller finance state, and I believe Georgia is as well. So those are
Sure.
usually the top couple right there.
Sure.
So
Yeah, I've
that's why
noticed
it's easy to go to
Indiana's
Texas and get notes.
right, right. Like the Mitch Steven is the guy who kind of got me started on the whole entire, he does the creative financing, everything like that,
Yep.
but he's a big Texas guy. Yeah. So, but
Yeah,
yeah,
he's in San Antonio, I think.
I think so. Yeah.
Yep.
But yeah, I mean, talking about kind of like back to where you're sourcing notes, obviously like when I'm creating a note, I want to make sure I'm Dodd-Frank compliant because I do a decent amount of them. And you talked about sometimes people who've had a house that they sold it um, previously or it didn't sell, or they kind of want to sell it to you and create that note. So do you help them originate the note with like a mortgage loan originator, that whole entire process, or is the note already created and you kind of backtrack and verify that it is Dodd-Frank compliant?
So if you're talking about one of the pillars of our business where we help people create loans, and yes, we
Yeah,
show them who is an underwriter that can specialize in exactly what they're doing, so they can have their borrower check off the box, if you will. The underwriter can on the borrower's ability to repay, because that's the key factor in creating seller finance notes is the ability to repay. Credit score is something to look at, but the ability to repay is most important. And so,
sure.
yes, we do have RMLO people that specialize in this, and we do know of attorneys in nearly all the states that can create note mortgages and title companies. So that stuff we kind of help the lender, the originating lender, get through all that, especially their first time understanding that, knowing to get a loan policy, knowing to have a title policy, where to board the loan, understanding the fees behind that. So yeah, there's a process to it and some education. So it's not a lot of people want to bypass those steps. And I'm sure you know who those people are. And what they do is they end up inserting their foot in their mouth at some point down the road because they're going to want to sell the loan to someone like you and I. And we're going to say, well, where are your underwriting criteria? Where are all your underwriting documents? And if they don't have any, which they typically don't, you're like, I'm taking a gamble here. I don't know this person's financial situation when you originated it. So we're taking a gamble here. So that definitely affects the value of that loan. So you're doing things the right way.
Right, for sure. Yeah, I mean, it was definitely like a learning process. I think the first deal I did not use a mortgage loan originator. And like you said, you kind of got stuck in it to where people didn't want to buy it because they didn't trust it. Where I was totally comfortable,
Yeah.
I vetted them to make sure they had the ability to repay. I used a rental property management company, and they said, yeah, you're compliant with, I think it was Indiana state law. You have to have a certain amount of income and all that, but nobody wanted to touch the note. So I kept the note for a long time, and it was good passive monthly income. But that's a huge, like what you offer people, that's huge. I mean, how complicated it is to wrap your head around selling that property and how many steps there are. Once you figure it out, yeah, it's fine. But with you guys
Yeah.
helping them do it, it is really hard. And mortgage loan originators are hard to find, surprisingly, especially in that specific state. Not all of them are licensed in all 50 states. So that's a
Exactly.
huge, yeah, that's a huge benefit. So that's awesome. So yeah. So if anybody has property that they're trying to sell, wants to create a note, they got to call. It's an awesome avenue to do
Absolutely.
business. So, all right, yeah. So moving on, I guess, what are your like big goals and some of your stuff that you're currently working on in the business? I mean, I guess business is booming, and you just keep going and going. Anything exciting you're doing?
Well, yeah, you're always trying to raise private capital. You're always trying to educate people out there so you have people to sell inventory to. And then you have the other
Sure.
problem on the other side of the economic curve of where you have to find the inventory to sell them. And so a lot of our focus right now, because as you heard, from the rumblings, from what you mentioned earlier about, people are having challenges finding that inventory or the quality of the inventory, and they're willing to pay a little bit higher to get the inventory. Well, we're trying to either A, harvest our own inventory like yourself, or B, try to go after these sources of inventory that no one else is going to, which is the seller finance paper. And so it's a lot more work to it. There's a lot more involved and a lot slower process, but the payday is exceptionally better as far as you're able to get these discounts on these notes because of all the work that you have to do to them. And so once you do that work to them or have a system and a process developed like we do, it becomes a little bit more efficient, and then it's a numbers game. Then we can go after more volume. So we're trying to ramp up our marketing volume to that. And that's one of our main sources of inventory right now that we're finding. So we've developed, a system. I partnered with another note investor. And so we've got a pretty nice little system down. So that's one of our main things we're doing now. So our goal is to get a couple of these bought and sold every month. And to build up to it, it takes a little bit of time. So we've been doing this for about 4 or 5 months, starting to build our momentum and our system and our process. So that's our goal, is to do a couple of these a month here real soon.
Nice. So you mentioned a little bit of like reworking. I mean, I think from what I was viewing, you only do first position loans, and they're always performing. Is that correct? Or are you starting to get into non-performing and rework the loan to make it performing?
So we've done non-performing before. A lot of the non-performing notes that we run into are just priced really high. So we don't choose to go there. And a lot of new investors want to go to the low-hanging fruit, which is the non-performing loan. That's what they want to do because it's cheap and it's easier for them. But they don't realize how much work is involved, or they may not know all the steps and all the loopholes and little pitfalls that you can run into very easily in non-performing loans. So they can be kind of scary, but they can also be extremely rewarding too. So there's a give and take to that. Performing loans are pretty simple. It's bread and butter. It's already got a strong pay history. It's going to continue to pay. Yeah, you're not going to make a home run on it, but it's going to have a single as far as the profit goes. And if you build up enough singles, you're going to be Pete Rose in the Hall of Fame. Exactly.
That's a good way to put it. So, let's talk about, I guess, more your criteria for what you're looking at for a note buyer. Let's say I got a note and I want to sell it to you. Performing note, everyone has like a different definition of a performing note. If someone's making 6 months of payments, some people say that's a performing note. Some people say it's not a performing note unless it's for a year. Kind of what's your definition of, like, what's your sweet spot for what type of note you're looking to buy?
That's a great question. And so the industry standard, as it's kind of taught by the mentors that I've been trained with, who are the guys that are pioneers in the business, have been doing it 30 to 40 years. They say a performing loan is somebody that's been paying before the next payment is due. If it misses that one payment but makes it before the second payment is due, then it's kind of sub-performing loan. Anything after a 3-payment miss is a non-performing loan. So if you were originating a loan and I was going to buy it and hadn't made their first payment yet, I wouldn't really consider it a non-performing loan or a sub-performer. I would buy it on the factors of risk. So if the borrower put down a very sizable down payment, like a 20, 25, 30, 35, 40% down payment, I feel a lot more secure of going after that loan without even having a payment made or funding it at the table, what they call a table fund. If the loan had a very low down payment, I would want to see a track record of maybe 8 to 10 months of very consistent, solid pay history before I would want to leap into that risk right there. So I value it on risk before I worry about what the yield of the numbers are. I make sure that my investment to value ratio, meaning what I'm paying for it versus what the collateral is worth, is within this window, whatever this number is. And I kind of look at it based on the geography around there and some other factors. So I'm more focused on risk than I am the actual return, and the return kind of just carries itself in there. And it's one of my last tolerant metrics that I use.
I got you. So it's very variable. It's not just like you have a specific deal criteria.
Yeah.
Okay.
There's some loans that we go after and we make a 7 or 8% on because the risk is so low and we see a ton of upside with it. And there's some loans that are pretty risky and we want to see double-digit returns on it, or else we won't buy it. So it all factors into the risk.
Sure. So what's your criteria for, I guess, like one of the biggest things that I see is like, most real estate investors know their market. So like they know what
Yeah.
prices are worth for that specific market. With note investors, it gets kind of crazy because like we invest all over. So like you think you know the state, but you don't know that specific city. What's your criteria, I guess, for establishing value in the property? I mean, obviously we have our comps, we got our tax assessed value, we have, comparable solds. I guess, how do you kind of verify that? Because same thing with, when I sell notes, people always want to verify the condition of the property. So I'm telling them it's in good condition. They want to send somebody out there to drive by the property, make sure it's still there. There's people out there who try to sell properties that, are demolished in a hurricane, and you look at Google Maps and it shows a property there, but it's not actually there, right? So I guess, how do you kind of verify the value of the property of the note you're buying?
That's a great question. It's a very confusing question because, sorry, um, a lot of people want to go off of comps, and like you just mentioned. So at some point, you're not going to have any comps for your property because it's going to be usually cash buyers, or they're just going to be rentals around there. They're not going to have traditional financing comps, meaning a bank financed properties in that area. So usually, if you're under the $80,000 to $90,000 price point, you're probably not going to find what we call conventional comps there to value your subject property, to know about what it's worth. So what we do is we look at the rental data and we say, okay, this house that's let's say 1,200 square feet, 3 bedroom, 1 bath, is bringing in about $1,000 a month of rent. So we say, okay, what are the taxes annually? What is about the insurance, annually? Let's back into those numbers and figure out really what that nominal rent data number is, that net operating income. And so we look at that number and say, okay, the principal and interest payment should be about right there if taxes and insurance and property management is paid for, if we take those things out. And then we multiply that by the local cap rate, the capitalization rate of a rental. So what the return of the rental investor is looking at, whether that's a 10% cap rate, a 6%, a 12%, whatever it is in the area. So you kind of have to know those numbers. And then from there, you multiply that, by 12 months, and then you get kind of this price of what the property values at with seller finance, and that gets you really close. And so it's kind of a guessing game, but it's also a gut feel of about, if you're getting $1,000 worth of rent out of a property, that you're pretty safe that if you're getting a $500 to $600 monthly payment over 20 or 25 years, you're going to multiply that out, and that's going to get you real close to, let's just say a $60,000 to $75,000 seller finance note. That's about what it's worth. So that's what I look at it, and that's how I value them when they're below a certain amount. Because we're buying a lot of loans that are about 30 to about, I don't know, $50,000 to $60,000 a monthly balance. That's really our sweet spot where we end up buying a lot. We buy a
Sure.
lot above and we buy some below, but our sweet spot is about 30 to 60,000.
Sure, sure. Yeah, I think the, seller finance with the higher yields, like under 100,000, you can see that 8 to 9% APR on the loan, is much more typical, which is better yield for us. And that's, for me, originating notes, that's kind of where I like to stay. If I got to buy the property for cash, I don't want to spend 150 and try to originate it at 3% or whatever the bank can give you, right? So
Yeah.
so that's huge. But yeah, like you said, kind of the rent, I think that's one of my biggest questions that I get asked when I have a private lender who wants to get on a deal with me. It's like trying to explain them what the value of the property is. With the lower income properties, it's difficult, but the rental, income is, that's kind of how I back into it. It's like you have to look at how much they're going to pay for rent, minus their taxes, insurance, and go through like that. So that's like a huge caveat. But let's say I'm a private lender. Let's say I got $100,000. I come to you and I say, hey man, I want to invest with you. I want to buy some notes. I want to partner with you. What are we going to look at?
Right. Well, we're going to interview you first, like I do with anybody. We're going to see if we're a good fit for you. We're going to explain why we separate ourselves differently from other type of what we call note brokers or note investors or partners in this. And we're going to kind of make sure that the expectations are going to be met for the investor. Because if they're extremely savvy in real estate and they've got a strong financial acumen, well, we need to know that up front so that they are fully satisfied with the return and the risk that they're getting. So we kind of show them like, this is how we do things. And if you don't want to do that, we're happy to find you a deal. It's just, we might not be the best source to be your partner. We just may be a good source for you just to offer this inventory, because we prefer to partner with people or help them through the process, because that's kind of what we like to do, because we feel like we get a lot of return business out of kind of coaching and helping people and mentoring them along in their first couple of deals. So that's what I would do. I would interview you first to kind of see what bucket you fall in. If you're extremely passive, if you're just kind of passive, or if you're more active passive. And that kind of shows me what kind of risk you want, what type of loans we should go after, and if you're comfortable to kind of to run on your own.
I got you. I got you. So that's,
Yeah.
yeah, that's, I think that's an interesting way instead of, most people out there that kind of just like, oh, give me your money and yeah, I'll invest it for you. But it's
Yeah.
much better to vet them, right? So that's,
Yeah.
yeah.
Well, I want to work with somebody that's not going to call me at midnight and complaining about some small things. I want them to
Right.
know that I'm going to take care of something if it's a problem, or I'm going to let you know if I see a problem, or you have a question. I'm happy to answer it to it, but let's do it in a mature way. So that,
Right.
so I know who I'm dealing with here. If I'm going to deal with somebody that's going to be an issue, then I'm going to know ahead of time and be like, okay, we're probably not going to be a good fit, but I have a couple of people that I trust if you want to work with them or talk to them.
Sure. Yeah. It's nothing like getting that private lender who asks you like, 60,000 million questions and wants to be involved in every aspect. And why don't you do it this way? Why don't you do it that way? It's like, well,
Yeah,
you came to me so that you could trust me and
yeah,
you could work with me, which yes, I don't mind explaining like, 99% of all this stuff, but every little minute detail gets a little difficult, right? But
yeah. They need to pay for some education and have a true mentor program with somebody that's going to spend a lot of time with them, and they have to make an investment to do that as well. So they're
right.
not making an investment per se and getting educated from me. They're buying a loan and I'm kind of helping them out. So I make it pretty clear up front, like I'm going to answer a lot of your questions, but like you said, getting into the minutia of things, it's going to be hard for me to take away time from my seat for stuff that I got to make money. Those are the types of people that I would say, okay, here's a training program that would be great for you. You're really wanting to get into this full time. That's awesome. And I support you. And these are the people that are going to help you do it. I just don't have the time or the service set up to help you get there. So
I got you.
I'd
So
love to
what's
charge you, $20,000 to train you over a year, but I can't guarantee I'm going to have all the time to do that for you. So
Sure, sure. And that's I think another thing I kind of would like to comment on, just, for my own personal, like opinion on it. People charge some outrageous stuff, and I'm all for mentoring. I'm all for like, getting that education because you need it, and there's a lot of free stuff out there like podcasts and stuff like that. And sometimes,
yeah,
you need that extra push to get that mentorship, kind of like I think you said you had. But I think I see a lot of people out there just like spend crazy amounts of money on the training. It's like if you just invested that, or if they just gave you the money or me and just said, take this money and work with it, they're going to make more money than if they try doing it themselves and never doing anything, just taking the training. They kind of get that information overload.
yeah. So you have to have the right training partner, and I can vouch for Note School and say that that's what they do. So some of the programs that you can run into out there are kind of expensive. You're making an investment, but I would encourage people when I talk to them about that, be like, that may not be the best fit for you, because I want you to take it seriously. Because if you're going to drop a sizable amount of money to get some real estate training, whether it's notes or whatever, be committed to be coachable, number one, and number two, to actually follow through with what you're being coached on and actually apply that in real life. Because a lot of people go into these seminars and stuff and they get excited about doing it, right? And they spend all this money, but then 60 days afterwards, they're just spinning their wheels. They don't know what to do, or they're just not motivated enough to actually go through it. So it's tough to see that, but that's unfortunately reality. So I definitely didn't want to waste my money. So I took all the information that I could and just applied it and moved forward. And so I don't know what the rates are in these classes that people take that actually become investors full time and make it. But I wanted to get a return on my money pretty quickly. So I was pretty
Sure.
motivated.
Sure, sure. Yeah, no, I mean, I just see people who take class after class and they'll spend, 20 or,
Yeah.
10 or 20,000. And, I think like the biggest hit that people take against note investing is that requires capital. You have to have capital to
It
play with,
does.
right? But if you add up all those classes you took and all the marketing costs you did for wholesaling and all that stuff, you could have bought one note, you could have got started is I guess, my point of view,
Yeah.
looking at
There's
people who
there's two
go out
ways.
there.
two ways to look at it, right? There's that way, and then going through the training. And even if you use the money that you have to go through training, there are still ways to do this business and not have any money into it. You have to be creative. You have to look at it through a different lens. So
Sure.
I do agree with what you're saying. And there's two different ways to look at it. You can just tether up to somebody and run with it that way and spend your money, or you can go get the training and kind of learn how to run a business yourself if that's what you want to do. If that's not what you want to do, that's okay. It's just, somebody like me would tell them, like, this is what I would do in your situation, and these are the benefits that you would get from going down either path. And then what's best for you is I want you to decide.
Sure, sure. So what's the biggest thing that you've learned in the business? I think everyone always has like learning things, and maybe if you don't have one specific thing, what's, I guess, maybe your biggest learning lesson, maybe your biggest mistake, or
Oh, wow.
something like that. Let's have a little fun here.
There's been many. So there's been some non-performing loans that have left wounds on my back from just not doing my due diligence right and getting burned pretty bad. First-time investors, they are rightfully pretty skittish about jumping into their first deal. They get analysis paralysis, and
Sure.
it's just getting into that first deal as quickly as you can. And maybe it doesn't have to be a large investment. Maybe it can just be a small investment, just so you can get your feet wet. You can just go through the motions, because everything in application is all theoretical, right? You're doing it in class, so to speak, in school, and you're learning how it works. But when you're in real life, it's a little bit different, right? It's a little
Sure.
different when you wire somebody the money and you don't have anything in return yet. You're just kind of waiting and be like, okay, am I really going to get paid? Did I just lose all my money? Like, what's going on here? So there's a trust factor that you have to get over with pretty quickly about the processes. But that's what's good about, being tethered or partnered with somebody like me or you in the note space, to where we've done these deals. We've done them 100 times. This isn't cause for concern. If you're going to lose sleep at night, don't do these deals. This
Right.
isn't for you. There's
Right.
other investments you can probably do that would, make you not crazy at night, right?
Exactly. Exactly. So to get back to it though, I mean, what's the biggest thing you've learned, I guess, then is it the certainty, just kind of like having to go through the process, quite a few times to get comfortable with it, or
Yeah. Yeah. So my
experience?
first notes, it took me about 6 months to actually do. I just did a way too much research and analysis, and I talked myself out of some good deals just because it wasn't perfect enough, right? You don't want to
Right.
lose money in this business, but if you stick to your core, criteria or your factors, and be like, does it check these boxes? Yep. Okay. Then that's what I need to do. I'm going to invest in it because it's checked off all the boxes that I want, and that's what we're going to do. So, the biggest lessons learned are always in your due diligence. You can never do enough due diligence. I know what due diligence to do now based on my experiences. So I've seen things that popped up. You're like, I didn't even catch that, because I didn't follow the checklist of things I need to look for. I need to look for the taxes, just verify what's going on there. I just bought a loan recently that I didn't get burned on, but I got kind of an unwelcome surprise where I didn't realize that the taxes had jumped up so high from the previous year, not realizing that the city put some water liens into the taxes to make the tax bill higher. So the escrow was short quite a bit. So it's
Yeah.
just little things like that you just learn. You're like, oh, why didn't, if I would have just went down my checklist like I would have, instead of getting in a hurry, I would have caught
Right.
that. So there's always small little things and due diligence that get you. So you just want to make sure that you just walk through the steps of, this, that, and the other.
The devil's in the details, right?
Devil's in the details. That's right.
You got it. So let's talk about, I guess something I've been asking people a lot lately is, current market predictions. We kind of touched on, real estate on the buy side. If you're buying a house, the real estate market's pretty hot right now. We got a lot of different things going on. We're coming out of, still making our way through the COVID lockdowns, everything like that. A lot of, people are speculating inflation. Some people are speculating, massive crash. Today I was listening to Bigger Pockets podcast with Robert Kiyosaki. He's saying it's going to be a massive crash. So you got a lot of different people saying different things. I mean, what is your personal outlook on that? If you'd like to share.
Sure. So I won't speak to the real estate stock, I'm sorry, just the stock market. I'll speak to kind of real estate. And
Yeah.
from what I know and what I see, I get a lot of my information from the Black Knight Financial Data, and they come out with a report once a month, and they talk about the mortgage industry and all the Fannie and Freddie and the portfolio type of mortgages out there, and they follow the trends and they see who's paying on time, who's not, what are the forbearances doing. And what we've learned over the past year is the forbearances looked pretty daunting at the beginning of 2020. And a lot of people were on the same page and said, look, this is going to be bad news, or this is going to be 2009, 2010 all over again. And I didn't see that at the beginning. I said, yeah, I guess this could get bad, but I think we've learned our lessons and the government's going to figure out something to do here. So what happened was they allowed forbearances, and they allowed extensions of forbearances to go like, from 6 to 12 to 18 months. And once these forbearances started to expire, we saw a lot of these loans are paying off and reperforming. And why is that? And then we realized all the annual appreciation that real estate was having. So it's the complete opposite of what happened in 2008, 2009 financial crisis, because real estate plummeted.
Sure.
And so mortgages went underwater overnight. And so people were upside down pretty quickly, and they were over leveraged. Now we have the opposite, to where we have an appreciation that soared so much, and the unpaid balances obviously just went down by they do every month. So we have tappable equity now that just came into play. So a lot of people are saying, hey, I can do a cash out refi. I can refi because loan rates are down to 2%. Or 1.99, or my house is worth $100,000 more than it was 2 years ago. I'm going to sell the house and live in a camper like I got, right?
Right.
So all these things happen, and so these forbearances just kind of, a lot of them disappeared. So right now, about 80% of the people that went into forbearance are now out of forbearance by either they refied the house or they sold the house, which makes up about, let's call it about 22%. And then the remaining, 58% or whatnot, 59% were reperforming because they got their job back, or the stimulus checks helped them, or something happened to where they're just able to start performing again. Maybe they really didn't need the forbearance and they just took advantage of it because they could. But that's a lot of people.
That is huge.
And that number is only growing as well, because we still have another couple million people in forbearance right now to go through that expiration cycle. So with all that being said, it appears to me that the appreciation of homes is rising so quickly. Now we're getting to an affordability issue. Okay.
Mm-hmm.
So now we have prices are skyrocketing and they're not slowing down, but now we have people's debt to income starting to have to get a little bit more to afford the same house. And so it's going to get to the point to where it's going to start causing an issue of people being over leveraged, and then they're not going to be able to afford these homes, which is going to drive down some pricing. So I think there's going to be a balance act of real estate at some point soon, maybe even as early as 2022, that we're going to see real estate prices not be appreciating as much as they are. I'm not sure if it's going to be a crash or there's going to be a correction or not.
Sure.
Everything's been so bullish for so long, and the stock market and real estate, it's hard to see something going the other way just because we've seen a bull market for so long. So that's kind of
Sure.
what I'm seeing, is that there's going to be an affordability factor that's going to cause an issue. And I think it'll cause a correction in pricing, which I think will also cause people to probably be more in the rental game.
Sure.
As far as borrowers becoming renters, they may not be able to
Right.
afford the house that they want, so they have to rent.
Well, that's good for us. I mean, on my side of the business, originating the
So we're
notes,
financing.
Exactly. So that's actually, that's good news for us. And same thing with, kind of like what you were talking about, I don't think there's going to be a massive crash with the real estate, in the sense that, if you bought maybe 2 or 3 years ago, it's not going to dip below that, right? Yeah, there could be some correction, right? But it's not, like you said, in the '08, it's not going to necessarily be like that. I mean, if we look at the last time we had massive inflation in the United States, was in the 1970s, so 1970 to 1979, and the average house, the price of a house was like $15,000 in 1969. By 1981, it was like 61,000. So that property net value never came back down. It just keeps rising, which is the real estate, the real estate market. So yeah, I think you're right. I think it'll level out a little bit. become maybe a little bit more affordable, but I don't think it's going to be a massive crash. But
Yep.
regardless, I mean, it's all good stuff for note investors. I
Yep.
mean, if you're buying the note and the real estate market keeps,
Hmm.
climbing incredibly, you have that equity in the property, right? So
Yep.
that's it's all good news for us, right?
It is. Yep.
So my only hope is, if it does come back down, I can just, buy a million properties and create a million notes, right?
Yeah, we know what to do, right? And that there's always everything is cyclical in real estate, right? And we just happen to be in a certain part of real estate that's cyclical that we haven't seen before, which is
Sure.
having such large growth in appreciation of real estate that it's just something foreign. So it's just like it was foreign when it was the crash of 08, 09 with real estate. And then everyone became a millionaire overnight who were flipping houses because it was the perfect storm. So now it's the perfect storm for seller financing. It's coming an affordability issue because the banks are putting you in a box. And if you don't fit in the box, then where else are you going to go? You're going to go someone like yourself, right? That can do seller financing, that can lend on real estate. So that's where we're going to see a lot of opportunities.
Sure. Sure. Well, Justin, it was an honor as well as a pleasure. I don't want to take up the rest of your evening. I know you're probably busy cooking some hamburgers and hot dogs in your camper there, maybe some
Yeah.
marshmallows, yeah. So, but yeah, if anybody wants to get in contact with you, I mean, you got your website. I'll put a link into the video here, and it's Bright Note or Bright Path Notes. You do it all, whether people need to sell their property to you, help them originate the note, or a private lender, private investor wants to get partnered with you. And also, if you just want to buy some of your notes, I saw some of your notes online. Maybe I'll grab one or two of one of yours in Gary, Indiana, up there. That's a
Okay.
cold area, but right there by the lake. I used to grow up on the lake, so
All right. We'll get you in one of those deals.
yeah, sounds good. I'll hit you up after this. But yeah,
All
enjoy the
right.
rest of your night, and I appreciate your time. And good luck to you, and we'll see you soon.
Yeah. Thanks for having me on your podcast. I appreciate it.
No problem. Talk to you later.